Morning, everybody. It's a pleasure to be with you online today. I've got the easy job, really, the economic update. I think the tax aspects are much more challenging from my perspective. But uh, I want to try and give you as clear a picture as possible. But I think the picture is clear. We have a number of challenges, but of course, there are some positive things on the horizon as well, as Chris mentioned. So let me make an apology on behalf of all economists. I guess on behalf of everybody who tries to predict the future. Prediction is very difficult, especially it's about the future. You may recognize the name, or you may not recognize the name Niels Bohr. If you've seen the movie Oppenheimer, he was Kenneth Branagh. He's a Nobel Prize winner in 1922, and I think his point a century ago is very relevant today in the current economic context. So let me just start briefly, if I may, with the global economy update. And I've got some points on the screen here, and I want to just highlight a few of these. I've used the phrase, it's a complex landscape. That's probably an understatement. In my professional career, I've never known the global economic environment to be so challenging or so complex. And that isn't to be negative. There will be winners and losers. There will be dynamics that will change the nature of business, and we will get through this difficult time period. But there's no doubt that the tariff war, I'll use that phrase, that Donald Trump has implemented recently, has heightened the situation. The figures are quite clear. Global growth has slowed down. And something like 70% of countries across the world are feeling the impact of the tariffs negatively. Now, we hope the UK will be less affected than many other countries. Only time will tell. And in this context, it's not surprising that many businesses are showing a degree of caution about investment in particular. Just wait and see what happens. That's understandable. And then inflation globally has been a bit stickier than we expected, although it has come down a long way. So let's be positive. It was good to hear that the Fed have dropped interest rates yesterday for the first time since Donald Trump was elected. So that will please the president, and perhaps Jerome Powell will keep his job for a little while longer. But inflation is still a problem. The consequence is that many central banks are being rather cautious. And we'll hear more about that in the UK today when the Monetary Policy Committee vote on interest rates. I will talk about it again later, but I don't expect any change today. If I'm wrong, and if they cut interest rates, I will be delighted. So I don't necessarily think that being right is a good thing. I hope on this occasion I'm wrong, but I'm pretty confident that they're going to keep interest rates where they are. And in the global context, we're all finding it difficult, particularly in terms of government debt. But I think we should remember that the countries that are most challenged at the moment are actually the developing countries. They have built up huge debts during and after COVID. And of course, the tariff war hasn't helped many developing countries because they need to export their goods out to the world. Therefore, I just want to, keep a note to mention the rest of the world, because we tend to think of ourselves, understandably, but others are struggling much more than we are. In terms of forecasts,
Joe Nellis,
etc.
apologies
Yes.
to interrupt. You haven't taken control of the slides at the moment, so if I could
Okay. Thank you
just
so much.
check where you want to be on the presentation,
Thank
and
you
I'll
so
move them
much.
forward for you.
That's very kind. No, wonderful. I've got control now. Thank you, Emma. Uh, I was just about to say, in terms of global projections, the IMF in their July report has put together some groupings here, and you'll see it on the slide. Their next report is due out probably in about 3 or 4 weeks. So it'll be interesting to see whether or not they modify any of their projections as a result of the tariffs. But just in general, you'll notice that the world economy last year grew at 3.3%. And it's forecast to slow down to around about 3% for the next 2 years. That doesn't sound so bad, but remember, normally, and when is normal? The world economy would typically grow at 4%, and so a slowdown to 3% is significant because it's not equally distributed. And if you look just below that, you'll notice that the euro area is having a difficult time, although there are signs of a slow recovery. Perhaps next year it'll grow by 1.2%. But just very briefly, again, if you look at the groupings, you'll notice the emerging and developing Asia are doing better than any other part of the world, although it's also slowing down, primarily because China has slowed down to about 4% growth. But what isn't on the slide is one country I just want to highlight. For me, the country to watch as an economist is what I call the sleeping giant, and that's India. India is doing very well indeed. I admit from a low baseline, but it's growing at over 6% year after year after year and projected to remain as a strong growth area. You'll also notice the USA, by the way, is expected to slow down. That doesn't please the US president. It doesn't please anybody, of course, because when the US sneezes, the world catches a cold. And other parts of the world you'll see there as well. As I say, I recommend the IMF report to you. It's free of charge, by the way, online. It's just fantastic. But it's a very detailed study of all around the world, each country and the regional groupings as well, as you see there. So if I just pull together the latest results for the major economies, you'll see there on the screen the top 6. Although I noticed Japan has been left off this one by the ONS for some reason. But, you know, the Prime Minister is right to say, or the Chancellor is right to say, that this year, at least for the first 6 months of the year, the UK has done better than the other major economies. So, you know, I want to make that point up front. Although growth has slowed down since the first half of the year, which we'll discuss later. But we did have a good first quarter of growth of 0.7%. And then the second quarter, there was a slowdown, but nevertheless, still positive growth of 0.3%. And again, you'll see the other comparisons. Germany has been having a hard time. But again, there are some signs of a slow recovery. And of course, you'll see Italy as well. So the UK has something to celebrate. Not a lot in terms of strong growth, but better than many other countries in the first half of the year. Just want to make a point before I leave the global context. I believe firmly that we are seeing in real time what I call a change in the spheres of influence. Throughout our lifetime, the USA has been the dominant sphere of influence, and the countries aligned are pulled along by the USA have enjoyed growth. But I think the USA's influence is changing very quickly, certainly under the current president. And that leaves a vacuum in terms of, where do countries, how do they realign? Who should they follow? Who should they support? The EU, of course, has been a major sphere of influence since the Treaty of Rome. And economically, it rivals the USA. It's a trade bloc, but in economic size, it's similar to the USA. But again, without being political, the Brexit situation has damaged the influence of the EU. We were a significant player in the European Union, and so our departure has diminished that significance to some extent. But I hope they will regroup and become stronger. And I put China here deliberately because China, in my opinion, is not only the next big superpower, but it's filling a vacuum in terms of spheres of influence. Many developing countries, particularly in Africa, are now increasingly dependent on investment and loans from China. And China is very, very active in terms of infrastructural development. I'm sure all of you are aware of that, but I do want to stress the significance of this, because China's growth as a major sphere of influence is leading to a realignment of countries. And the implication, I think, is long-term. It's not just about the balance of power, but it's about future trade relationships. I often describe China's strategy of investing and lending and supporting many developing countries, especially in Africa. I often describe that as modern colonialization. It's money creating a bind, a link between countries. And I think this is going to last for a very long time. To me, this is the future, not only of China, but of many, many countries. Trade relationships are developing, are changing. And of course, the tariffs that we've seen recently are accelerating these changes. So that's a big point, and I'm going to leave that. And I apologize for teasing you with that, but I think it's one that we should watch very, very carefully. But of course, the primary focus today is the UK economy. And I want to just take you through the major data points. And as Chris mentioned, this is really a backdrop to the budget that's coming up on November the 26th. And I don't think there'll be many surprises for you when I say that, we are in as I say, a challenging situation. I did mention that the first half has been positive growth. Sadly, the August figures that just came out a couple of days ago, for that 1 month, there was zero growth. So I'm expecting that the Q3 figures, when they come out in mid-November, to be no better than Q2. I suspect they'll be a little bit worse. So I think the second half of the year is going to see a continued slowdown. For the year as a whole, however, for 2025, we're expecting growth between 1 and 1.2%. Which is fine. It's much better than it has been for some time. And I think we should celebrate that. And it's important to not always be negative. And I am a positive person, by the way. You'll have heard the figures yesterday about inflation. They've remained at the July figure of 3.8%. So no change there. But of course, it's still almost double the Bank of England target. And no doubt that will be featured today when the Monetary Policy Committee announce their decision on interest rates at 12 o'clock. You'll be online to hear that, of course. And of course, the inflation rate is not a huge surprise to all of us here today. High domestic energy bills, the business taxes, the national insurance increases, the hike in minimum wages. This is being talked about day in and day out as to what's causing this inflation. And of course, this inflation is not equally distributed either, because food price inflation is now running at over 5%, which affects the people most of all at the lower end of the income scale. And so sadly, consumer business confidence is fragile. I'm not going to exaggerate and say it's falling. It has fallen, but I'm hoping we're now going to head into a period of stability. And as we head towards the budget, my fingers are crossed that we begin to restore some of that confidence. Of course, the big challenge for the Chancellor is the fact that public sector spending has been rising year after year, and the government has had to borrow more and more and more. The rise in spending by the public sector, again, is well understood. The cost of welfare, the cost of healthcare, and the rising cost of pensions is not just a short-term, but a long-term burden for the public purse. And so the Chancellor, is under tremendous pressure. And one wonders, what is she going to do on November the 26th? But, I've got views about what she should do. I'm sure you have as well. But she only has three options. There are no more options. If we don't have growth, then the options are either tax increases, or spending cuts, or more borrowing. Because growth is not going to solve the problems that we face in the short term. I'm hoping growth will come through in the longer term, but it will not happen overnight. So those are the three things that we'll be talking about during the MHA budget on November 26th. So I hope to see some of you there. Thank you very much. Now, the latest graph, I'm not going to linger on this, by the way. This shows the estimated 3-month growth in GDP to give you a sense of the dynamics over the last couple of years. And you'll see we've been down, we've been up, we've been flat, we've been up, and now we're back down again. Again, this is not the sort of picture that is good for long-term business planning. What we'd like to see is steady growth, sustainable growth. This volatility creates uncertainty, not surprisingly. But again, we're going to hear much more about that from the Chancellor. This is a bit of data that I picked up from the Institute of Fiscal Studies, which I thought was an interesting, just small point to note. This shows you and it's a very long-winded title, the average annual growth in real household disposable income per capita. In other words, it's allowing for inflation, allowing for taxes, what's happening to income per head throughout each of the parliaments back to 1951. And there is one very clear picture. I'm not going to go through each of these parliaments, by the way, but I think you'll realize the trend is downwards. The growth in incomes per capita in real terms, we have not been doing very well in recent years. And you'll notice there the forecast by the Institute of Fiscal Studies throughout this parliament is for growth of less than 1%, well below 1%. Which makes life difficult for many people, particularly those at the lower end of the income scale. Oops, I shouldn't have done that. And now I'm in trouble. Emma, can you sort that out for me, please?
Sorry, Joe,
Help
I'm
me
not sure what problem you have. Everything's displaying as it should do.
Oh, great, because I'm seeing the slides differently. That's fine. That's great. Thank
If
you
you want
very
to go
much
on to the
indeed.
next slide, I'll just navigate forward for you.
There you are. There you are. It's worked. Thank you so much. Sorry, folks. Now, one of the economic indicators that I'm sure all of you online keep a close eye on is the 10-year government bond yield. I don't want to teach people in your situation basic finance, but government bond yields are critical, of course, because first of all, it represents, in very simple terms, the interest that the government has to pay on the bonds being issued. And I'm simplifying that, of course. But this is indicating, of course, a rise in the cost of government borrowing. However, as you will appreciate, the bond yields represent the benchmark for the cost of capital for business loans. And therefore, that's not good news. As the bond yields go up, then even if you're AAA rated, it's going to cost you more to borrow money. And of course, the bond yields also represent the benchmark for fixed rate mortgages. 80% of mortgages in the UK are fixed rate mortgages. And I've just shown here on the graph, in August 2020, we then had the lowest 10-year government bond yield in our history. The figure was actually 0.1%. Just reflect on that for a moment. If we could have all refinanced our debt at that time, we would be very happy today. But we didn't, and the government didn't, and it couldn't. The financial markets would surely not allow that to happen. And you'll notice a little spike, by the way, around about 2022. Well, that was the mini budget, that Liz Truss quasi-quarantine moment. But of course, bond yields were already on the up. And as of September the 10th, and I checked the figures yesterday, by the way, they haven't moved very much. 10-year bond yield is about 4.6%. So the challenge here is, as the national debt, as the total government debt rises, the interest charges on that are rising. And for the current fiscal year up until next April the 5th, it's estimated that the interest on the national debt in the UK is going to be around about £111 billion interest. And that's not paying back the capital. That's simply standing still, which is one of the reasons why the Chancellor is desperate to get the national debt falling by the end of this Parliament, and why she's imposed the self-imposed fiscal rules that she will not borrow to fund day-to-day expenditure. Again, we'll hear more about that at the budget, no doubt. And in terms of government finances, I want to stress this next point. It's a very important one to appreciate, and has been talked about recently by many commentators, not only myself, but the Office for Budget Responsibility, they estimate, and remember, they are independent of the government. This is not a political organization. It's set up by the government, but to provide independent oversight. They've estimated that the size of the national debt could treble over the next 50 years. Now, think of the interest charge today on a national debt that's roughly about 100% of a GDP. Well, if that were to treble, then you can imagine the scale of this is going to become a huge problem for the UK. And there are three main reasons for this, which are not a surprise: an aging population, the climate change and the cost of transition to a green economy, and the rising political tensions increase costs for governments, particularly wars, of course, and lots of other factors, cyber conflict, etc., and the trade tensions as well. But the reality is, and these are the words of the OBR, we are on an unsustainable path. We simply cannot continue as we are to allow the debt to rise, because it is inevitable that we're going to have to raise tax revenues, or we're going to have to somehow return to a high growth, high productivity economy. which is the big challenge we face. Let me shock you a little bit with some of the figures. Well, no, the next slide is the one that's going to really shock you. This is looking backwards. We'll look forward in a moment. I just pulled together data back to 1951 using the ONS and the OBR data. So this is a screenshot. This is not anything that I've manipulated. But in terms of the size of the debt post-war, our debt was something like over 200% of GDP. Then as the economy grew, the ratio fell. So economic growth solves the problem. The ratio fell to just 100% almost in 61. And then we had 3 decades of exceptionally low public sector debt as a percentage of GDP. Now, these 3 figures, look at them all, 38, 34, 33%. Those were the decades when we should have been borrowing more, I would argue, for one particular reason. We should have borrowed more when we could afford to borrow more to fund our infrastructure, our energy, our water, our roads, our railways, our airports, but we didn't. Government after government focused on allowing the debt to fall as the economy grew. Understandable in many ways, but it's always easy in hindsight to criticize. But I wish we'd borrowed more then, because these were exceptionally good decades. These were the decades where certainly a person of my age had good times. And then, of course, you'll see the jump up because of the financial crises. And then we had the COVID pandemic. And we're now roughly back to where we were back in 1961. But that's life. We can't change that. But the future is the big challenge that the government and we as a country face. Huge challenge coming up. Again, this is a screenshot from the OBR, and PwC have done a bit of work on this as well. You'll notice the baseline here shows that the size of the debt as a percent of GDP is projected to go to over 300% by 2070. Now, it'll not affect me personally, but it will affect many of you online. This is mainly due to the simple, first of all, the first reason, an aging population. But on top of that, we have what are called the post-war shocks, the cost of rebuilding, the cost of restocking defense equipment. These things cost money. And then the baseline with 21st century shocks, that's estimated to be the impact of AI. AI will displace some people from their jobs. Some people will not have the skills required. Of course, many others will benefit from AI. The type of the new skills that are coming through. But it's estimated that this will be a shock to the economy because of permanent unemployment for some people. And so, I mean, this information, by the way, is provided to the government by the OBR. And what it's saying is, we've got to do something. The train is coming down the track. You can't stop the train, but you can get off the track. You can react before you're hit by the train. And this is a high-speed train that's coming towards us. It will gather momentum, as you'll see, but we need to think about this very, very carefully. This is not going to go away. That's for sure. Now, in terms of some of the economic indicators, you'll have heard the inflation this week is still at 3.8%, as I mentioned earlier. So my graph needs to be updated today, but we didn't want to manipulate these slides any further. So the inflation is stayed at 3.8%. But let's celebrate the fact that we're a long way from the 11.1% that we had a couple of years ago. Now, when will inflation come back down again? Well, the Bank of England will tell us today. They are going to tell us, I'm quite sure, that inflation is going to rise again in September to around about 4%, and then it'll start to edge down again. And as we go into 2026, we'll get back towards the 2%. So I am feeling confident, unless there are some external shocks, that this 2% target will be achieved somewhere in the course of the next 9 to 12 months. It may be sooner, maybe a bit slower, but it's heading back to where we'd like it to be. And of course, interest rates today will be decided. The vote will be taken. I've said already once or twice, I think they will stay at 4%. But I am expecting another 1 or maybe 2 cuts this year. Certainly 1. They may pause till January for the second cut. Now, just conscious of time, our labour market is proving to be, rather tight is the phrase that's being used these days. Unemployment has been rising. It's now at 4.7%. Uh, in my lifetime, the lowest unemployment figure that I can remember, and I think officially, was 3.5%. So we're above our long-term low point. 4.7 is not a disaster, but it has been rising, and that's not good news, of course. And the big challenge surrounding the labour market is the fact that more than 9 people of working age, the classification that's used for official purposes, over 9 people are classified as economically inactive. That's a huge burden to the economy, not only in terms of the welfare cost that some of them may be claiming, but it's the use of resources, scarce resources, that's being unused. And we need to get those people of working age, as many as possible, back into work, because we need to push the economy forward. And something like 30% of this number are categorized as long-term sick. Again, a lot of people have struggled post-COVID. Mental health problems are dominant. And I'm not suggesting that everybody can go back to work so easily. It is a challenge for all of us to look at this and try to resolve the problem. And of course, you'll have heard already this week the number of employees on payrolls is leveling off. In fact, I think it declined slightly when the figures come out this week. So we have a very tight labour market. Now, tight labour market sounds good. Labour shortages could be good if the economy is booming. But we've got labour shortages at a time when the economy is not booming. And that's because of the scale of this economic inactivity. And then the other figures that have come out this week, the UK job vacancies, and they continue to fall, falling back more perhaps to normal numbers. But the message is clear that businesses are now hesitating in terms of recruitment. And it's not a big surprise that with national insurance having gone up last year, it started in the financial year, and of course with minimum wages going up, the cost of employing is rising for companies, and that's causing a little bit of a hesitation in terms of recruitment. Again, nobody online will be surprised by that, I'm sure. So let me finish in the next couple of minutes just to give a quick summary of the UK and the outlook. We are growing. Let's be positive, but the growth needs to be much stronger. It is sluggish, and growth will be the solution to our debt problems as a country, but it's not going to happen overnight. The inflationary pressures remain. As I mentioned, inflation is now still at 3.8%. And so, that's going to take a little bit longer before we begin to feel a bit happier about inflation. But I've said already, I do expect the Bank of England will cut interest rates further. Whether I don't think it'll be today, probably November the 6th at the next meeting of the MPC, or the one before Christmas. I think it's December the 18th. But again, my fingers are crossed that they do that, because we do need to give the economy a little bit of a shot of adrenaline. Of course, the fiscal constraints are the big problem that will be the focus of the budget in November, because it limits the capacity for the government, for the Chancellor, to do something to kickstart the economy. If they were to go out on a spending spree, it would stimulate inflation again, and then we get into this trade-off. And of course, the trade disruptions are going to continue, and they have impacted growth in the UK, and it has put a pause on many investment decisions. But that will hopefully stabilize in the coming months. And of course, I mentioned just a moment ago the labour market challenges. And as I say, many sectors are continuing to experience shortages, and many don't want to recruit, but also, it's hard to get the people with the right skills at the moment as well. In terms of the outlook, therefore, I think it's going to depend on 3 key issues. The first one, the fiscal tightrope, that's going to be absolutely essential. How the Chancellor gets out of this situation, we will have to wait and see. But it's a challenge for her and for all of us. I think the government, I'll avoid politics, but the government needs to restore credibility. When the government was elected, I think I'm sure most of us thought this is a 10-year parliament, this is a 10-year government. With the size of the majority, they should be able to get themselves re-elected. But damage has been done to their credibility in the last few months with the toing and froing and reversal of some policies. And of course, the government needs to really help businesses by unlocking many of the policy reforms and allowing the economy to breathe and to grow. And just to conclude on this slide, and before I finish, I think the next couple of years are going to be critical for the future of the UK economy. We need to break out of this sluggish state that I've mentioned, and we need desperately to achieve sustainable long-term growth. And so finally, what are the big challenges? Look, this is a very busy slide, and I need to stop in a moment, but there's nothing going to surprise you here. The big challenge of growth, sustainable growth, is critical. We've got to improve our capital stock. We've got to improve productivity. The government's industrial and services strategy, they've got to push that hard and make sure it's effective. The aging population is a long-term problem. And then, of course, AI is going to impact all of us, business and government. We've got to adjust to that and embrace it. And, of course, trade. We need to trade, not just with the EU and the USA. We've got to embrace trade across the world, and we've got to get more people back into work, of working age. And finally, of course, the transition to the green economy is going to be a major challenge. And on that note, thank you very much for listening. I wish you the very best.
Fantastic. Thank you, Joe. Some great insights there, and a really useful backdrop to the other sessions, etc. We did have a question prior to this around regarding budgets allocated to climate change, which countries are currently moving towards a large number of sustainability initiatives. And I thought that's quite interesting, because our recent budgets haven't really had a green agenda to them at all. If anything, you could say some of the policies marginalised historic green initiatives, like capital allowances used to get 100% relief if you invested in green equipment, but then they changed the policies. You got 100% on everything, doesn't matter if it's green or not. So you could argue that's a slight accidental anti-green policy. My comment there is around Denmark, who has a real kind of green agenda at the top of all of its fiscal policies, around farming, around energy, around incentives and such like. So that's my high level tax answer on that. And when we come back later, Joe, if there's anything else to add, don't hesitate to jump in.